Imagine I sold you a ticket to a party where the entry fee is your entire life savings. I tell you the music will never stop, the drinks will never run out, and the house price only goes up. You'd probably call me a liar. But what if the people hosting that party were Apple, Microsoft, and Nvidia? Suddenly, the lie sounds like a strategic investment. Right now, 7 companies, just 7, control nearly 36% of the entire S&P 500. We call them the Magnificent Seven. We treat them like gods. We've been told they are one-decision stocks. You buy them and you never, ever sell. But history has a nasty habit of repeating itself, especially when we're too arrogant to check the rearview mirror. Back in 1972, there was another group. They were called the Nifty 50. They were the blue-chip royalty, the invincibles, the stocks so good you could buy them at any price. They made up 45% of the market. And then, the sky fell. Today, we're going to look at the uncomfortable math, the hidden mechanisms of market psychology, and the terrifying evidence that we're living through a 50-year-old ghost story. This isn't just about stocks, it's about a psychological trap that has caught every generation since the dawn of capitalism. The year is 1972. The vibes are immaculate. Bell-bottoms are in, and the stock market is a money-printing machine. If you were an investor back then, you didn't need a complicated strategy. You just needed the Nifty 50. These were the giants. Disney, McDonald's, Polaroid, Xerox, Kodak. Names that felt like they would last until the end of time. The logic was simple. These companies are so dominant, so profitable, and so stable that no price is too high to pay for them. Investors stopped looking at earnings. They stopped looking at value. They started looking at narratives. Sound familiar? By the peak, some of these stocks were trading at price-to-earnings ratios of 80, 90, even 100. For context, the average market PE is usually around 15. People weren't buying businesses, they were buying religion. They believed that even if the stock was expensive today, it wouldn't matter in 10 years. They called them one-decision stocks. The only decision you ever had to make was to buy. Selling was for losers. But here is the glitch in the human brain. We tend to mistake a great company for a great investment. They are not the same thing. You can own the best company in the world, but if you pay 1,000 times what it's worth, your investment is still garbage. In 1973, the music stopped. The oil crisis hit, inflation spiked, and suddenly the invincible Nifty 50 weren't so nifty. They didn't just drop, they evaporated. Xerox fell 70%, Avon fell 85%. Polaroid fell 90%. It took nearly 3 decades for some of those stocks to see their 1972 highs again. Entire fortunes were wiped out, not because the companies failed, Disney and McDonald's are still here after all, but because the math finally caught up to the hype. Now, let's zoom forward to today. Look at the Magnificent Seven: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla. In 1972, the top 50 stocks ran the show. Today, it only takes 7. The concentration is even more extreme now than it was during the dot-com bubble of 2000. We are currently seeing a level of market lopsidedness that would make a 1970s fund manager sweat. When 7 companies carry the weight of the entire world's economy on their back, what happens if one of them trips? The narrative today is that AI is the new electricity. We're told that these 7 companies have such massive moats and so much cash that they are essentially untouchable. They are our one-decision stocks. People buy Nvidia at any price because AI is the future. People hold Apple because everyone has an iPhone. But let's look at the hidden mechanism that nobody is talking about: passive investing. Most people today don't pick stocks. They buy index funds or ETFs. When you put $100 into an S&P 500 fund, you aren't spreading it equally across 500 companies. Because the index is market cap weighted, about $36 of your 100 goes straight into those top 7 stocks. This creates a feedback loop. As more people buy index funds, more money is forced into the Magnificent Seven. This pushes their price up, which makes them a larger part of the index, which forces even more money into them the next month. It's a self-fulfilling prophecy. It's not necessarily that these companies are getting better every day. It's that the mechanical structure of the modern market is funneling all the oxygen into the top of the room. This is exactly what happened with the Nifty 50, just through a different straw. Back then, it was institutional herd mentality. Today, it's algorithmic necessity. The danger of a crowded trade is that when everyone is standing on one side of the boat, it only takes a small wave to flip the whole thing over. Think about the psychology of the exit. In 1972, when the Nifty 50 started to slide, everyone realized at the same time that there was no fundamental reason for the prices to be that high. The one decision to buy quickly turned into a desperate decision to sell. But because the stocks were so overpriced, there were no buyers left at the top. The floor didn't just drop, it disappeared. We see the same irony today. We praise these 7 companies for their stability, yet they are some of the most volatile assets in the market when things get shaky. Why is nobody paying attention? Because it's hard to see a bubble when you're inside the soap. Psychologically, we're wired for recency bias. If the Mag 7 have gone up for the last 10 years, our brains tell us they will go up for the next 10. We find reasons to justify the absurdity. We say this time is different. In the 70s, they said this time is different because of global corporate expansion. In the 90s, they said it because of the internet. Today, we say it because of artificial intelligence and unlimited cloud growth. But the math of 1972 hasn't changed. Interest rates matter. Inflation matters, and most importantly, valuation matters. You cannot escape the gravity of earnings forever. If you look at a chart of the Nifty 50's ascent and overlay it with the Mag 7's run since 2015, the lines are hauntingly similar. It's like watching a car crash in slow motion where the driver is looking at his phone and the passengers are cheering because the speedometer is going up. The stakes are higher now than they were in 1972. Back then, the average person wasn't nearly as invested in the stock market. Today, through 401ks, pension funds, and retail trading apps, the entire middle class is strapped into this roller coaster. If the Magnificent Seven have a Nifty 50 moment, it won't just be a bad year for Wall Street. It'll be a generational crisis for Main Street. So, where does that leave us? Are these 7 companies going to disappear like Polaroid or Kodak? Probably not. Apple isn't going out of business tomorrow. Microsoft isn't going to vanish, but that's the trap. The lie isn't that the companies are bad. The lie is that they are safe at any price. History shows us that great companies can be terrible investments if you buy them at the peak of a psychological mania. The Nifty 50 investors who bought at the top didn't lose their money because the companies failed. They lost their money because they paid for 50 years of growth in advance. They bought the future at a price the future couldn't afford to pay back. We are currently seeing Nvidia trade at valuations that suggest it will own the entire world's computing power forever. We are seeing Tesla priced like it will sell a car to every human on Earth twice. Maybe they will. Or maybe we're just repeating the same script with shinier toys. The most dangerous words in finance are "it's different this time." It's the phrase that has preceded every major crash in history. It's the phrase that makes us feel smart right before we get humbled by the market. So, ask yourself, are you buying these stocks because you've done the math, or are you afraid of being the only one not at the party? Are you an investor, or are you just part of the herd? The Nifty 50 thought they were the masters of the universe in 1972. By 1974, they were a cautionary tale. The question isn't whether history repeats itself. The question is, when the echo finally hits, will you be the one holding the bag? The mirror is showing us 1972. We just have to be brave enough to look at it. If this video made you pause and rethink your portfolio, then my job is done here. Most of the finance world wants to sell you hype, because hype is profitable. Here at Finance Conscious, we prefer the uncomfortable truth. If you want to stay awake while the rest of the market is dreaming, hit that subscribe button. We're going to keep digging into the psychology of money, the traps of the system, and the history that everyone else is trying to forget. Because the best way to survive a bubble is to recognize you're in one before it pops. I'm Khan, and your financial consciousness is the only thing that will keep you safe in a world of one decision lies. I'll see you in the next one.